When launching a business, the essential components of your success are the quality of your ideas and your willingness to put in the work required to see those ideas come to life. In the milk of capitalist meritocracy, the cream rises to the top. With gumption, know-how, and a little steely-eyed grit, there's nothing stopping you from turning all that money currently languishing in your trust fund into a thriving business enterprise. Go ahead, make your mark on an opportunity-laden world. Wait, what's that you say? You don't have a fat trust fund to draw from? Well, in that case, looks like you'll have to raise some capital. The prospect of going hat in hand to beg for money from the holders of capital isn't one that appeals to most entrepreneurs. It probably wasn't the aspect of building a business that occupied your fever dreams growing up. Nonetheless, for those of us without inherited wealth, borrowing money to start a business is a necessity. So let's explore the ways you can get your mitts on some startup capital for your new business venture. Welcome back to another episode of Living Fire. If you never want to miss an upload, make sure to subscribe to the channel. Number 1, use personal savings. Self-funding may not be realistic for many entrepreneurs, yet the fact remains that according to research, 78% of startup business owners didn't seek startup financing outside of personal savings or job income in their first year. You might not be flush with cash, but you can always try doing things to change that. You could sell your car and use the bus to get around, sell your house and rent an apartment above a restaurant, or keep the house and get a home equity loan or a line of credit. Just be sure to make the payments or else you'll be wishing you got that apartment when you had the chance. Number 2, tap into retirement accounts. Another option is to borrow money from your assets. You can borrow money from your 401k or your IRA savings account. These are obviously not risk-free options, and this should not be your first resort. But if you were looking for a life of minimized risk, you'd have chosen a more standard line of work. So be careful, but know that these options are available to you. Number 3, ask friends and family. Another solution is to hit up your friends and family for money. However, it's one thing to imperil your own finances with the inherently risky activity of starting a business. It's quite another to put your close personal relationships in jeopardy. Consider the risk to which you're subjecting your loved ones. Also, consider the fact that using money from friends or family might drive you to stick with a losing proposition longer than is rational. If you decide to seek business funding from friends and family, do yourself a favor. Go through all the proper legal channels and have the paperwork professionally prepared. You should also make sure to request a loan, not equity investment. Ask for the latter, and your friends or family will have the legal right to be involved in major decisions involving your business. Number 4, get a personal loan. When you're launching a startup, business loans can be quite hard to obtain, mostly due to your lack of existing business revenue. It's a classic chicken and egg problem. Situations like these are where personal loans can become a solution. While getting a business loan is often dependent on characteristics like the health and credit worthiness of your business, getting a personal loan is entirely dependent on your personal characteristics. Expect lenders to closely scrutinize your credit score, source of income, debt-to-income ratio, and proposed use of the loan. Personal loans generally top out at $35,000, although a few lenders cap it at $50,000 or higher. This amount is a small fraction of the amount you can borrow with a business loan, which can be $1 million or more. Simply put, startups are inherently risky ventures, so the amount of capital lenders are willing to lend you is going to be strictly limited. Number 5, use credit cards. Credit cards can always help you out of a jam in your personal life. The same applies to financing your startup. Small business credit cards can have limits as high as $50,000. Considering that this is funding you can use without having your business plan scrutinized by some grand poobah, credit cards may be one of the most convenient means of financing a budding business. Of course, the convenience of credit cards are balanced out by high interest rates. You don't want to let your credit card debt linger with the interest piling up, so plan to pay it back as soon as possible, within the no interest grace period if possible. Number 6, apply for grants. Free money. What better way could there be to fund your startup? Obtaining a grant to fund your young business isn't easy. That's why you don't hear about it happening too often. However, grant programs do exist. You might be able to get a grant from a number of sources, including federal grant programs, state and local government grant programs, private grant organizations. You can find grant programs tailored to specific types of businesses, as well as certain segments of the population. There are small business grant programs for veterans, women, single mothers, and other groups. Be prepared to write an extensive and detailed proposal if you want any hope of landing a grant. Competition for grants is tight, and only the most compelling pleas are heard. Grant programs can offer amounts as small as a few $100s to recipients. So don't expect to write a wave of free money to business success. However, if you find a program that you match up well with and have a particularly poignant story to tell and the time to tell it, you have nothing to lose by giving it a shot. Number 7, get a bank loan. Entrepreneurs trying to launch their first business venture are more likely to secure just about any of the above types of loans than a bank loan. Banks tend to want to see a history of profit before they'll let you sniff their money, an obvious problem for a new business or startup. Nonetheless, if you have a significant amount of collateral and excellent credit and industry experience, don't count out bank loans as a possible source of capital. A commercial loan from a bank can resemble a mortgage. There's a fixed interest rate, fixed monthly, quarterly payments, and a maturity date. Number 8, get an angel investor. Angel investors are wealthy business people who finance startups that have the potential to make them even wealthier. Angel investors don't offer loans. Instead, they offer equity investments, which buy them a share of the ownership of your company. According to research, angel investments often amount to around $600,000, so we're not talking chump change here. It's a very tempting funding avenue to pursue if you've got more potential than cash on hand, but beware. You'll also be giving up between 10% and 50% of your business. Number 9, use a crowdfunding platform. Crowdfunding takes the traditional approach to raising startup capital and turns it on its head. Instead of bringing your sales pitch to investors and institutions hoping to be heard, you get a platform on which to lay out your plans and your needs for your budding business. By utilizing the advantages of the internet, you give investors the chance to come to you, a much more efficient means of pitching woo to your potential funders. Number 10, raise funds on Kickstarter. By far the most popular crowdfunding platform in existence, Kickstarter has become synonymous with crowdfunding. On their website, Kickstarter boasts that over 19 million people have backed a project, over $5.4 billion has been pledged, and over 190,000 projects have been successfully funded. Kickstarter is what's known as a rewards-based fundraising platform. So rather than invest in the pursuit of financial or equity return, investors typically get a reward for their generosity. In most cases, backers get to use the end product or service in advance of everyone else. Kickstarter is a fine option for the entrepreneur with a compelling pitch to make. But keep in mind, the platform releases the funds donated to your business only after your campaign reaches its funding goal. Only about 36% of Kickstarter campaigns reach their funding goal. The rest fall short, in which case the campaigner gets nothing. Number 11, raise funds on Indiegogo. Indiegogo started as a fundraising platform for independent films, but has since expanded to become a general-purpose crowdfunder. Today, Indiegogo offers opportunities in even more business categories than Kickstarter. Although the platform doesn't get the same degree of media attention as Kickstarter, Indiegogo actually has more live campaigns going at any one time than does Kickstarter. That may be because, unlike their better-known competitors, Indiegogo crowdfunding campaigns don't necessarily have to meet their fundraising goal to receive their funds. Number 12, raise funds on GoFundMe. GoFundMe is a crowdfunding platform most often used for personal causes and unfortunate life events. However, you could certainly attempt to raise startup funds through the site. This platform is not linked to an existing community of investors. Instead, donations are most likely to come from those in your personal network, as well as those to whom you can get the word out. To this end, GoFundMe is optimized for social sharing. With GoFundMe, there is no all-or-nothing funding requirement. However, you will have to pay the same fees regardless of whether your campaign raises $2,000 or $20. If your new business is related to some kind of personal or social cause, GoFundMe is a crowdfunding avenue worth pursuing. Number 13, enter a funding contest. Funding contests are a non-traditional means of raising money for a business startup. Then again, tradition is overrated. Programs like the Amazon Web Services Startup Challenge and the MIT $100,000 Entrepreneurship Competition offer startups the chance to compete for thousands of dollars in funding every year. These contests receive an overwhelming number of applicants, as you can imagine. So make sure to present your pitch in a unique and compelling way. Your ideas need to stand out in a sea of thirsty funding seekers. Number 14, use peer-to-peer lending. Peer-to-peer or P2P lending, sometimes known as social lending or crowd lending, takes the crowdfunding model of Kickstarter and combines it with more traditional lending practices. P2P services are essentially matchmaking services that connect casual investors with businesses that need funds. P2P loans have two primary advantages over traditional loans. The first is that the application process is usually online. You don't have to meet with some stuffed suit or open your business premises for inspection. The entire process can be done at home, in your bedclothes, like most of the truly important things in life. The second advantage is that the process for getting approved and receiving funds is usually much faster than with traditional lending. The downside is that P2P lenders tend to be particularly risk-averse when it comes to lending to those with iffy credit. Number 15, get a microloan. Microloans exist for the benefit of borrowers who fall short of the collateral and cash flow requirements necessary to acquire traditional bank loans. Because microloans are for small amounts of money, they are considered less risky than other types of business financing. Loans of $50,000 or less are generally considered microloans. You might be able to get this type of financing from sources such as nonprofit or online lenders. And with that, we've reached the end of this episode. All about 15 smart ways to finance your startup. Do you have a startup? What do you utilize to earn funds for a new venture? Get involved and let us know in the comments section down below. If you enjoyed this one and found it helpful, remember to leave a like on the video and to subscribe to Living Fire for even more amazing videos just like this one. Thank you for watching, and we'll see you in the next one.